Stop obsessing over earnings reports. Stop staring at PE ratios every single morning. Seriously, that habit is not giving you the edge you think it is. You need to understand the one invisible engine that actually drives the repricing of everything: stocks, gold, real estate, and crypto. If not, the next major market wipeout is going to catch you just as blindly as the last one did. Today, we are pulling back the curtain, and by the end of this video, you are going to learn how to read the monetary tap like the top macro hedge funds do. You will know how to position yourself before the crowd even realizes the game has changed. Just last week, my feed was nothing but panic, big companies missing earnings, forecasts getting slashed, and retail investors spiraling in their group chats, convinced the sky was falling. But here's the funny thing. If you had stopped staring at the doom-scrolling headlines and just glanced at the Federal Reserve balance sheet, you would have seen a totally different movie playing out. A quiet, stealthy wave of liquidity has already started flowing, while most people are out here using a microscope to analyze a tidal wave. And honestly, that approach is doomed from day one. You really need to think of the financial markets as a giant reservoir. When the giant tap gets turned on, even the ugliest, leakiest little dinghy is going to rise with the water. But when they pull the plug and drain that reservoir, even the most luxurious mega yacht is going to smash into the rocks. If you are constantly missing out on massive bull runs or getting trapped holding the bag in bear markets, there is a reason. It is probably because you are obsessing over the paint job on the boat while completely ignoring the water level. So today, we are throwing those lagging quarterly statements right in the trash, and we are going straight down into the plumbing of the global financial system. Look, when most people start investing, they get handed the same old rulebook, telling them to study the fundamentals, check the profit margins, and listen to the CEO. And I am not saying that is entirely useless, especially if you are literally buying an entire company. If you have the infinite patience of Warren Buffett to hold for 50 years through 40% drawdowns, those metrics actually matter. But for the rest of us, the 99% of investors who actually want to see real excess returns this cycle, fixating on quarterly filings is a trap. It creates a dangerous illusion where you think you're buying earnings growth, but in reality, you're almost always just buying liquidity. This leads to the most expensive misunderstanding in the market. Picture this: earnings look incredible, and the news is euphoric. Retail investors finally pile in, thinking the story is confirmed, but spoiler alert, they just bought the exact top. Fast forward a year, the macro data looks terrifying, layoffs are everywhere, companies are missing expectations, and financial TV anchors are having on-air meltdowns. Ordinary investors panic and sell everything in despair, and then they watch from the sidelines as the market violently bottoms and rips to all-time highs without them. That is usually the exact moment you get mad, you tweet that the market is rigged, and you say Wall Street is manipulating everything. But the truth is way more uncomfortable. You were just reading the wrong scoreboard, hyperfixating on a corporate income statement. Meanwhile, the real boss of the system, the global central bank balance sheet, was doing the actual driving. Let's take a little trip back to March 2020. You remember it, the entire world literally shut down, factories went dark, and unemployment went vertical. Consumers were locked in their living rooms baking sourdough, and by every traditional valuation metric in the textbook, the stock market should have been buried for a decade. But it wasn't. The S&P 500 didn't just bounce. It pulled off an absolute face-melting V-shaped recovery and sprinted to new historic highs. Why did companies suddenly figure out how to be ultra-profitable while all their stores were closed? Of course not. There was only one reason. The Federal Reserve fired up the printers at breathtaking speed, and trillions of dollars were shotgunned into the system. Central banks globally flooded the markets with a tsunami of liquidity we had never seen before. And that brings us to the holy grail you need to understand. Global liquidity, specifically the supply of money. You might hear economists throw around the term M2 and think it's some boring academic jargon. It's actually beautifully simple. M2 is just a broad measure of how much money is out there in the wild: cash, checking accounts, and savings accounts. It's the closest thing we have to a live tracker of the actual fuel inside the financial engine. To really get this, you have to break your current mental model. Stop looking at a stock or a house or a Bitcoin as a thing whose value keeps changing. Try looking at the asset as a stable anchor and the currency pricing it as the thing that is violently expanding and shrinking. Let me give you a ridiculously simple example. Imagine a world with exactly 10 apples and exactly $10, where one apple equals $1. Tomorrow, the guy running the printing press decides to print 10 more dollars. Now there are $20, but still only 10 apples. Suddenly, your apple is trading at $2, but did the apple get sweeter? Did it get crunchier? Or did it hire a better CEO? No, the apple is exactly the same. It is just that the ruler we used to measure it just got cut in half. That is the darkest, deepest truth of Wall Street. Most asset booms are not assets becoming more valuable. They are just the money supply inflating. Wall Street will sell you a sexy story about AI, innovation, and productivity, but behind closed doors, they know the secret. Market appreciation is mostly just a monetary illusion. Don't believe me? Go pull up a 10-year chart of the S&P 500. It looks like a glorious rocket ship going up and to the right. Now, divide that exact same chart by the M2 money supply and reprice the stock market not in fake shrinking dollars, but in the total supply of money. The chart you get is going to shock you because that rocket ship suddenly looks completely flat. What you thought was a raging bull market making you rich was actually just you running on a treadmill to keep up with the money printer. You thought your wealth was compounding, but in pure purchasing power, you were barely treading water. And the terrifying part, anyone who didn't own hard assets during that time was getting their life savings actively diluted in real time. So if liquidity is the only game in town, how do you actually track it without needing a PhD in economics? First rule, never listen to what central bankers say into a microphone. Watch what they do when they raise or lower interest rates. They're just changing the price of money. They are making borrowing a little more or less annoying, but when they expand or shrink their balance sheet, quantitative easing and quantitative tightening, they are changing the quantity of money. That is the difference between changing the price of gas at the pump versus physically draining the gas tank of the entire economy. And here is a secret indicator that almost no retail investor knows about, but it will completely hack your market timing, the reverse repo facility, or RRP. Think of the RRP as a gigantic multi-trillion-dollar VIP parking lot run by the Fed. When the big banks have way too much cash and think the stock market looks a little too scary, they park their billions in this lot to earn a safe, boring yield. That money exists, but it is sitting on the sidelines. It is not pumping your bags. But here's the kicker. When you see that RRP balance start draining fast, that is an incredibly bullish signal. That is billions of dollars pulling out of the parking lot and rushing back into the casino looking for yield. It flows into bonds, stocks, crypto, you name it. And not too long ago, the Fed was on TV talking incredibly tough, threatening more hikes, sounding terrifying. Yet the stock market kept stubbornly grinding higher and retail was completely confused. But if you looked at the plumbing, the reverse repo parking lot was violently draining. It was a stealth money printing operation. If you traded the scary headlines, you got shook out. But if you tracked the liquidity, you rode the wave. Write this down and tape it to your monitor. Fundamentals dictate who survives, but liquidity dictates how high everyone flies. So where are we standing right now in this cycle? Liquidity does not move in a straight line. It breathes like a tide. It goes from tightening to bottoming to expansion to absolute euphoria. And when inflation runs hot, they hit the brakes and your portfolio gets crushed. But when the economy starts cracking, when banks start wobbling, and the system looks like it is going to snap, policymakers always pivot. And sometimes it is a massive announcement. Sometimes it is a quiet backdoor bailout. But that exact turning point is where generational wealth is built. This is because the market will launch upward months before the news actually sounds good. Fast forward to today, the debt burden on major governments is astronomical. The US is spending so much just to pay the interest on its debt that it is practically a national crisis. When debt gets this big, they mathematically cannot keep money tight forever. The system would literally break. Fiscal dominance takes over. They have to print, somehow, some way. And we are likely sitting right in that muddy, confusing transition phase right now. The headlines are scary, the volatility is high, but the deep underwater currents are slowly shifting back toward pumping the system. The path of least resistance over time is up. So what is your actual game plan? Step 1, drastically change your media diet and stop watching financial entertainment that is engineered in a lab to give you anxiety. Go straight to the source. The St. Louis Fed has a free public website called Fred. You can go there right now and track the Fed balance sheet, the M2 money supply, and the reverse repo lot. On charting sites, you can actually divide the S&P 500 or Bitcoin by the M2 supply to see the real chart. Once you start looking at the market from this macro balcony, those dramatic 5-minute red candles stop scaring you. You realize everyone else is screaming at the ripples while you are watching the tide. Step 2, align your portfolio with the water level. If liquidity is draining, you run away from garbage zombie companies that need cheap debt to survive, because they will die first. But when that liquidity tap starts turning back on, you want to be holding the most pristine, scarce, hyper-reactive assets on the board. You want dominant tech monopolies that print free cash flow, and you want gold, which has literally been the ultimate middle finger to fiat currency debasement for 5,000 years. And yes, you want Bitcoin, which has basically evolved into the most sensitive, real-time smoke detector for global liquidity on the planet. Here is the harsh, unfiltered truth of the financial markets, while the guy next to you is sweating over how many iPhones Apple sold in Q3. The apex predators of Wall Street are just watching the invisible pipes, pumping trillions of dollars around the globe. Once you see the liquidity illusion for what it is, you stop being the passenger, getting violently thrown around by the waves. You become the navigator. If you are tired of being exit liquidity for smarter money, if you actually want to front run the crowd, stop trading the narratives, watch the waterline, Because once you learn how to read that tide, you will never look at a sudden market crash or a face-melting rally the same way ever again.